Cryptocurrencies have had an exceptional year, reaching a combined value of more than $3 trillion for the first time in November. The market seems to have benefited from the public having time on their hands during pandemic lockdowns. Also, large investment funds and banks have stepped in, not least with the recent launch of the first Bitcoin-backed ETF, a listed fund that makes it easier for more investors to get exposure to this asset class. Alongside this has been an explosive rise in the value of stablecoins like Tether, USDC, and Binance USD. Like other cryptocurrencies, stablecoins move around on the same online ledger technology known as blockchains. The difference is that their value is pegged one-to-one to a financial asset outside the world of crypto, usually the US dollar. A substantial proportion of buying and selling of crypto is done using stablecoins. The total dollar value of stablecoins has shot up from the low $20 billion a year ago to $139 billion in November. In one sense, this is a sign that the cryptocurrency market is maturing, but it also has regulators worried about the risk that stablecoins could pose to the financial system. Stablecoins use cases are exploding in nature, from day-to-day transactions to cross-border remittances to payments within the crypto ecosystem. And this past week saw Meta Platforms pilot its stablecoin payments wallet, while the world's largest payments processor, Visa, launched a crypto advisory service and added an interesting note that stablecoins might become the medium of exchange rather than cryptocurrencies. Today, we're focusing on digital currencies, the rise of stablecoins. I'm Tolulope, Adeleru Balogun. Welcome. This is Business Edge. Now joining me for today is Ola Atoshe. He's the CEO of CoinCoin Exchange and, of course, a regular here on Business Edge. Ola, welcome back to the show. Thank you so much for joining me.
Yes, very good morning to you, Tolu, and thank you for having me again.
All right, so let's take a bit of a trip and sort of break this down. So for the longest time, the conversation around cryptocurrencies has mainly focused on Bitcoin and a few others. This particular increased interest and conversation around stable coins that we're seeing now, where is that coming from?
So the obviously stable coins in their very nature are virtual assets, and I think it's important to mention that the ease of movement of stable coins across the blockchain is really what's giving individuals and businesses interest in stable coins. So in so many ways, they can get access to stable coins, they can pay for goods and services in a cross-border fashion a lot quicker than they could do with, your native US dollar, if you like. And of course, the charges for stable coins are considerably lower in terms of, doing a transfer or making an exchange from local currency into stable coins. So again, a lot of individuals and businesses see this as a viable means and a quicker way of doing business. And it's common sense. It's the evolution of money as we know it. And of course, I think this is why we're seeing this increased demand for stable coins. And if you like, a boom in, trade in that sort of cross-border fashion, now that it's easier to move value from one place to another.
Okay, so let's look at the history of stable coins. So initially, they were introduced in the mid-2010s, and stable coins are centralized operations, meaning that someone is in control of them. Tether is ultimately controlled by the owners of the crypto exchange Bitfinex, based in the British Virgin Islands. USDC is owned by an American consortium consisting of payment providers Circle, Bitcoin miner Bitmain, and crypto exchange Coinbase. Binance USD is owned by Binance, another crypto exchange which is headquartered in the Cayman Islands. This seems to present a contradiction to the decentralized idea of cryptocurrencies. So would you consider stable coins to be true cryptocurrencies?
I think that's a very good question. I would probably start with Circle. So USDC moving closer to a market cap of 30 billion. They do have some regulations, state regulated in the U.S., and they are regularly audited by Grant Thornton. So we can say, as far as USDC is concerned, that every stablecoin mined, if you like, or every stablecoin issued is backed by $1. So there is some sort of regulation going on with USDC. So I think that does give our community at least some view that there is some they are going to be held to account, certainly by the state regulators in the USA. So that's the USDC phase. As far as USDC is concerned, yes, they're ultimately owned by Bitfinex, and of course, the view with USDC, I've been impressed over the last few months, is the SEC has actually looked into USDT, and thus far, it is obvious that every single stablecoin is actually backed by US dollar. So again, there is a view that pure decentralization isn't the case with stablecoins. But if we begin to look under the surface, certainly over the last few months, those businesses and individuals who use stablecoins can be rest assured that these companies, are being held to account, and every issued stablecoin is backed by an actual US dollar.
I like that you've gotten there, because that's really my next question. So while stablecoins, like other cryptos, use the same blockchain, the difference is that the value is pegged. It's able to peg its value one-to-one, usually to the US dollar or commodity. So how does that work, really, for the stablecoin being able to peg its value? Break that down for us.
Yes, I mean, it's fairly simple. I mean, the private companies, Tether, in the case of USDT, Circle, the consortium you mentioned, in the case of USDC, simply have to have $1 for every, stable coin issued. So in so many ways, I think with USDC is perhaps the best place to start if anyone wishes to do their own personal research. There are attestations online which clearly show the amount of dollars which are available, fully audited by an external firm, that shows that for every USDC in circulation, every single stablecoin in circulation, they're backed by an actual US dollar as in real money, real cash. So that's how they're able to do the pegging. And of course, as much as we have obviously the other cryptos, Bitcoin, Ethereum, what have you, a lot of people still want to have that option to be able to cash out of standard cryptos, and stablecoin provides them with that safe haven, if you like. But what we find is a lot of sort of demand we see for stablecoin isn't necessarily from those who hold cryptocurrencies. It's actually coming from those who hold emerging market currencies. So in the case of the Naira, for example, or the Ghanaian cedis, we find people, companies, businesses who actually look into the stablecoin as a means to hedge against inflation, for one, and also as a means, to transport value to their clients and to their customers. So there's an increased need for stablecoins, not just as a safe haven or even just as a hedge to inflation, which we're seeing a lot of now, but also as a means of transport of value and to pay for goods and services.
Okay.
So as I mentioned earlier, of course, it's the evolution of money, and it's given certainly the African continent an opportunity to do things in that sort of intranational way, by which we've not seen before. So some positivity there.
Okay, so very quickly before the break, there are some concerns and questions about whether the organizations that control stablecoins hold enough financial reserves to be able to maintain that one-to-one fiat ratio in the event of a crisis. Because many say that these one-to-one ratios are not automatic. They depend on stablecoin providers having reserves, which you've talked about, of financial assets equivalent to the value of their stablecoins in circulation, which adjust with supply and demand for investors. Now, a lot of people say there's enough money in circulation, inflation is at the right levels right now. But do you think these concerns are valid about them being able to have enough of those reserves that equal the value of the stable coins that are being put out?
I think it's a fair question to say that there are some questions or further questions to be asked. After all, USDC, USDT, BUSD, USDP, which is another one, are all issued by private companies. So if we're now moving into this realm of where private companies are issuing, if you like, money. So there has to be some sort of accountability, more oversight, more regulation, as to the value behind stable coins. So I'd certainly agree with that. But as I mentioned previously, USDC being the preferred one has got some state regulation out of the US, and the attestations they've put out have come on the back of an audit of their company and their processes by Grant Thornton, who's an external auditing company. With regards to the largest one, which is USDT, I feel we should mention USDT of recent have been challenged by the SEC in the States to obviously give some evidence that every single tether is backed by an actual US dollar.
Okay, Ola, you're getting to the next question I want us to get to, and that involves the regulation. So let me interrupt you here because we need to take a break. We will pick up that conversation because with the growth and adoption of cryptocurrencies around the world, we've seen pushback from governments and regulators. So let's get into the regulatory aspect and the possible individual risk that stablecoins present when we come back. Ola, hold on. You're watching Business Edge. The conversation around the rise of the stablecoin continues right after this. Now, still with me is Ola Atoshe, the CEO of CoinCoin Exchange, and we're looking at digital currencies, the rise of the stable coin. So, Ola, you started taking us into the conversation I want us to get into next, and it appears that regulators are certainly worried about the stability of stable coins. Now, a U.S. report published in November by the President's Working Group on Financial Markets said that they potentially pose a systematic risk, not to mention the danger that a huge amount of economic power could end up concentrated in the hands of one provider. In October, the U.S. Commodity Futures Trading Commission fined Tether $41 million for claiming to be 100% backed by fiat currency between 2016 and 2019. Across the pond, the Bank of England Governor Andrew Bailey said in June that the bank was still deciding how to regulate stable coins, but that they had some difficult questions to answer. So what is the risk that the financial system seems to be afraid of? And Ola, do you think it's a valid risk or it's more about upsetting the status quo?
Well, I mean, I'll speak, with two hats on here. I am an ex-banker myself, so I understand what the central banker's concern is from a regulatory perspective. The lack of oversight of perhaps how the funds move across the blockchain, the fact that you can move a considerable amount of value across the blockchain in stable coins, which you can't do with traditional banks. Traditional banks, as you probably know, controlled by ultimately a few number of individuals, and that control is overseen by regulators, and there are a number of things which, again, aren't possible with banks to, regular individuals. So I would probably say that the banks are perhaps concerned about their immediate future because people have started to realize that with stable coins, they can achieve so much more, much less cost, right? So the banks are worried about their future and whether they'll still be able to provide the services they provide, now that we're in the new world of stablecoins. So that's one of the concerns they have, and of course they're coming out, trying to poke holes in the world of stablecoins. And I think that's all well and fair. I think the world of stablecoins should stand up to scrutiny. and I believe it does. Where it does, I think, the bankers, both central bankers and private bankers, should either, join the stablecoin, foray, either through their central bank digital currencies, which is one thing that's happening, or by allowing their own customers to store and hold stablecoins virtually with banks. So that's one option I'd say is out there with the bank, out there for the banks. The other thing I would say is that from a futuristic perspective, there aren't really that many concerns with stablecoins and how they're currently being used. Any different from what's being done with the banks, if you like. So if there's a concern of a source of funds or KYC and all these other things, these are issues, which the banks themselves have. And because of the very digital nature of our exchanges and the processes around stablecoins, a lot of the issues that the banks have had historically, the exchanges are solving them. And they're able to sort of, conduct real-time KYC or know your customer, if you like, real-time checks on users, individuals, and businesses who are conducting transactions using stablecoins. So I think whilst the Bank of England's governor, is mentioning sort of his concern or his view, I believe his view is largely his opinion, and I don't think it affects the economy or poses any systemic risk. The real risk, if any, from a monetary value, is going to be faced by the banks and maybe ultimately the central banks, because a lot of the flow and a lot of the value and the money and the currency which flows through the banks right now, and they charge a maybe higher fees for, is now going to start flowing through, the exchanges and obviously other cryptocurrency platforms. So I think their concern is that loss of revenue, and that loss of revenue, funny enough, may affect the banks, but it actually helps, businesses, it helps individuals. Again, it helps connect, and make business possible in realms where it wasn't possible previously, especially here in Africa.
Yeah.
As an example.
And I think that's a lot of what people see in regards to the hue and the cry and the concerns being stated now. So let's come forward to this week. So Meta, formerly Facebook, has well-publicized plans for a stable coin. We've heard central bank digital currencies also will put fiat currencies on the blockchain if and when they arrive. The Bank of England is consulting on a digital pound, while the EU and China are also moving ahead. Do you think that whatever these risks and concerns are concerning stable coins will be reduced with a more diversified market, with more of the central bank digital currencies coming out, the sort of e-naira we're seeing, this digital currency or the digital equivalent of country currencies also as well? Will a more diversified market reduce whatever risk and concerns people have?
Well, I think the very nature of the central banks coming out with their own stable coin and calling it a digital currency, I think it just goes to prove the point of stable coins in the first place. Stable coins are here to stay; they work, and of course, the central banks, they're all looking to introduce their stable coins or digital currency. The real question for the central banks will be one of interoperability. How quickly can the central banks move to make it possible for individuals and businesses to deal in that cross-border fashion, the way they're currently dealing in the stablecoin universe? So this is a question for the central bank. I think the question of sovereignty, in terms of how does sovereignty apply to currencies, I think this is a big question that a lot of countries have. And again, I move away from Europe and China and the sort of larger economies who have strong economies on their own. I look to Africa that has 55 countries and 48 currencies. How do we become strong? Do we become strong through an e-naira, for example, which is Nigeria's digital currency, or do we become strong by a more decentralized stablecoin, which allows, businesses in Africa to grow and do more, again, generate more revenue purely on the basis of having access to each other in a way we never have since, the countries in Africa, came sprang to life over 100 years ago. But now we're seeing it's a whole new world. It's the future of money as we know it. I can take my stable coin from Nigeria, where I was on Monday, and I can be in Ghana as I am today, and I can cash out my stable coins into local currency, and I can could do so very quickly and have money to spend on business.
Okay,
this is me as an individual. So I think the stablecoins are here to stay. They've already solved the problem. I think the central banks can try to catch up, but ultimately I think people will decide what they feel works for them, because stablecoin gives them some anonymity
options,
whereas central banks currency doesn't. So
all right, Ola, I need to ask you this very quickly. Time is not with us. So we saw stablecoin move from valuation of around $20 billion a year ago to $139 billion in November. 2022 is around the corner. Two very quick predictions that you have for the stablecoin. As you said, people are moving away from the traditional financial system, finding their way, getting their anonymity, and being able to do business across borders and across countries. Two very quick predictions you have for stablecoin in 2022.
I think we will see the market cap of stablecoin go up considerably. I would be cautious on throwing out a number, but I would probably say, we're probably looking closer to the sort of maybe perhaps 330 billion figure potentially in the coming year. And I see that rising every year. Moderate rise, of course, pending regulations, but I see it rising all the same.
All right. Ola Atoshe, thank you so much for joining me. We'll be touching base with you again soon.
Thank you very much, Tolu. Thank you.
All right. And as this conversation is happening internationally, of course, Ola was bringing how these stable coins, how cryptocurrencies can, of course, decentralize the financial systems on the continent and actually help us leapfrog some of our connectivity and, of course, transactional issues. Can that be done in the coming year? Will that be a way to help us, of course, move along with transactions and unify Africa more as one unitary or one, of course, business bloc? You're watching Business Edge. When we come back, it's NC4 to watch. And here are a few stories we're keeping our eyes on. We start this, of course, in South Africa, and here is what we have for you. Not South Africa, I beg. Well, it's the utility company Eskom that has been slapped with a obligation to comply with emission standards pegged at about 300 billion rand. Now, it is either that or an immediate closure of 16,000 megawatts of coal and liquid fuel-fired generation capacity. There is an appeal that may finally decide things in January. Savannah Energy PLC has announced that it signed a share purchase agreement with ExxonMobil Corporation, ExxonMobil International Holdings, and Esso Exploration Holdings. It also separately signed with Petronas Overseas Ventures. The deals were relating to the purchase of each of their entire upstream and midstream asset portfolios in Chad and Cameroon. Uganda is considering restricting some of Kenya's raw and processed agricultural products from its market. The ban would only be lifted after Nairobi reverses a ban on Uganda's own products. According to Rebecca Kadaga, Uganda's East African Minister for Community Affairs, the cabinet asked the Ministry of Agriculture to identify and list Kenyan products that were to be banned by the Ugandan government within a short time. And finally, the African Development Bank's board has approved a $210 million loan to co-finance Phase 1 of the Nigeria Special Agro-Industrial Processing Zone program. The AFDB said the program will help to unlock Nigeria's agricultural sector potential and boost industrialization through the development of strategic crops and livestock. The 7 states involved are Ogun, Oyo, Imo, Cross River, Kano, Kaduna, and Kwara. And that's Business Edge. 11 a.m. West African time, we put business conversations, economic and financial ones, from here on the continent front and center. Follow us on social media, download our mobile app, and watch us live. I'm Tolulope, Adeleru Balogun. Have a great day.